Hello and welcome to our webcast on Lessons from the Future Fund. For those who I've not met yet, my name's Kirsty Spicer, I'm the Content Director at Brightday, and with me today in the studio we've got Alan Kohler, who is not only the founder of Eureka Report but also the Editor-in-Chief. Thank you so much for joining me, Alan.
My pleasure.
Now, before we get into what we're going to talk about today, I just need to advise you of our general advice warning. So this webcast may include general advice. It does not take into account your personal objectives, financial situation or needs. Before acting on this information or acquiring a financial product, you should consider the relevant product disclosure statement. Now, before we get stuck into things, I'll give you a bit of an overview of what we're going to talk about today. We're going to start off talking about Australian shares and how much the Future Fund has in this particular asset class compared to industry and retail funds and self-managed super funds on average. We're then going to talk a little bit about infrastructure and property investments and how they can help you if you don't already have these in your portfolio. And finally, we're going to talk about managing changes to your portfolio, whether they be small changes immediately or maybe bigger changes over a longer period of time. Now, you can ask questions at any point in time by filling the question box out on your viewing screen. And because Alan is in the hot seat today, he'll most likely be the one answering them, but I might chime in here and there because I don't like to be quiet. So, Alan, one of the most noticeable differences between how the Future Fund invests and how large industry super funds and retail super funds invest is the amount in Australian shares. So at the moment the Future Fund has around 6%, but a balanced fund on average could have anywhere between 15 and 30% in Australian shares. That's a really big difference.
It is, look, perhaps we should just go back a bit and look at some of the basics of the Future Fund. I mean, what you're quoting there is what they currently have.
Correct.
And that's fine. They actually don't, in their kind of mandates, although they list what they have in Australian equities, in their investment policies, they look at equities overall as an asset class.
Yes.
Overall, and their policy requires 40% in equity. And that includes private equity of 7.5%, listed equity of 32.5%. And what's quite interesting is that at the moment, they've got more in equity than the 40%.
Yes.
It's interesting. 45% is in total what they have in equities. The 6.4%, as you said, in Australian equities. In global equities, developed and emerging markets, they've got 33.1% and a further 12% in private equity, which is unlisted. And so they kind of, they're overweight equities, as it were, but underweight, as you say, Australian equities versus everyone else, which is quite interesting. I guess you can take that to be a comment on what they think about Australian equities versus, overseas equities. And certainly they've got more in private equity than their mandate or their policy suggests. 7.5% versus the current allocation of 12% into private equity. So, and the other thing worth noting is that they actually changed their investment policies in 2009 after the GFC.
Yes.
Because they had a lot more. In those days they had a lot more in illiquid assets to begin with than after the GFC, because they got a bit of a fright, as did everyone, of course. And so what they say in their thing is that while we're conscious that the GFC was an extreme event, it served to encourage us to look at the level of illiquidity in our original policy and decided to reduce it. That is to say, to increase their level of liquidity. And that's worth noting. I mean, for example, originally they had 35% in equities, 40% now. They had 30% in tangible assets, which is infrastructure and property, and now that was reduced to 35%. So I'm not letting you get a word in edgeways here.
That's all right. The questions are building up in my head.
Well, I mean, I just think it's worth looking at how they've changed, and I mean, they do have a much greater asset allocation to what you'd call tangible assets, such as property and infrastructure, I think, than most people do. They have the ability that they've got the fact they've got two things in their favour. One is that they're really big, so that they can employ these managers, and they can actually put money into airports and stuff, whereas your self-managed super fund has a bit of trouble doing that.
That's right.
And the other thing is, and this is really the kind of nub of the issue, is that they have a long-term mandate. They have a long-term view of things, right? So they don't actually need liquidity every day. They don't need to be able to buy and sell most of their assets. What do they say about that? That they interpret long-term as meaning rolling 10-year periods. Well, 10 years is a long time. Interesting.
But do you think that's a reasonable time frame for a super investor?
Well, of course. Well, if the thing about super is that it's for retirement, right?
Correct.
You can't take the money out until you retire. So, assuming you retire at 65 and you start work at 25, that's 40 years. And I would have thought rolling 10-year periods is perfectly reasonable. But the trouble is, everyone is looking on their computers every day to see how they're going. And they got me on the news every night saying stock market went up today, down today, tomorrow down, up, down, up, down. So it's like everyone's kind of focused on the daily ups and downs, when actually what we're all doing is investing for decades.
Now, I'm really glad that you brought up the time that people, that the future fund take to invest. Now, self-managed super funds have close to 40% in Australian shares. Now, do you think that's born out of taking a short-term view of immediately wanting income, or because it's people defaulting to what they feel most comfortable with and what they know?
That, sure. I mean, it's what they feel comfortable with. And the other thing is that I might be wrong, but I don't believe that most self-managed super funds actually have a proper asset allocation strategy. I think that asset allocation means shares, cash. That's it. It's 40% shares. Probably, I don't know. Is that true? Sounds a bit low to me. I reckon it's more like 60 probably, and the rest of it's cash, because everything else is a bit hard. I mean, they might have the money in a residential property maybe, and borrow against their fund to do it. But it is difficult to find funds, and the other thing is that I'm not sure whether people who have gone to an advisor with their fund, which is what most people do, and they've given the money to an advisor, and the advisor gives it to a bunch of managers. I'm not sure they kind of have in their head that money's in the market. I mean, I think they might think, oh, my money's with Colonial First State, rather than the market, right? Well, in fact, it's in the market.
So, for people at home that are watching today, what do you think that they can take between the differences between what the Future Fund has in Australian shares, and what industry and retail funds have, and what self-managed super funds might have?
Well, look, I think the main lesson, really, the main thing to think about is, and I've been on about this in my Saturday email, is that liquidity carries a cost.
Yes.
What it is exactly, who knows? But it is the case. I gave an example in my Saturday email last Saturday, taken from Mark Sowerby, who is the Blue Sky Alternative Investments guy who I interviewed, who said that the difference between his private equity and these hedge fund investments, which hedge funds basically is listed liquid investments, is private equity provided 20% return, hedge funds 10%. So the cost of liquidity in that case was a full 10%, which is horrendous, right? Because private equity is illiquid. You have to, when you invest in private equity, it's 5 years, basically. So I don't think it's really 10% cost of liquidity, but that's really what there is a cost, whatever it might be. And it's worth actually looking at the future fund's returns.
Absolutely.
It's
just over 11% over 5 years.
Where is it?
That's all right. I know it's 11% over 5 years.
Yeah, no, but there's a whole. No, but the thing is here it is. No, it's not.
Well, whilst Alan looks for the number that he's
Shuffle.
after, I'll just talk a little bit about liquidity. So if you couldn't keep up with what Alan was just talking about, liquidity is the ease of which you can buy and sell an investment you own. So if something's illiquid like private equity, meaning that it's not very easy to get your money back, if not near impossible, you want or you should demand as an investor a higher return to compensate you for having your money tied up for a minimum period of 5 years, perhaps even longer, unlikely to be less if we're talking private equity. So have you got your number now?
No, I left it behind.
Well, that's all right. So
anyway,
they've returned 11% over 5 years.
Yeah, that's right. And 3 years was 13 point something percent.
It was better than that, yes.
And over the since 2006, which is when they were formed,
yes,
it's 7.6%. And that includes the GFC. So the returns, including the GFC, are obviously lower. Since the GFC, they've actually done very well, 10% plus returns. And what they say in their policy is that the new asset allocation, which I was talking about, which you can find all this stuff on their website, I should say.
Mm-hmm.
You go to their investment policies, which is kind of what I've been printing here, and you can get all of their policies, what their asset allocations are now and what they ought to be, and of course their returns. They say that their revised asset allocation is expected to produce a real return, that is after inflation, of between 8 and 9% per annum over the long term, with a very high expectation of avoiding capital loss. So, and that's kind of their boffins have worked that out. This is not just what they guess. They've actually worked that out quantitatively, that's what they can expect. So 8 or 9% per annum when inflation is real, 8 or 9% real over the long term,
mm-hmm.
when inflation is 2.5% as it is now, that is double-digit returns. And so you could be confident as an investor, if you were able to match their asset allocation, you would get that kind of return over the long term. Unfortunately, you can't. It's really hard because, a lot of their stuff is, well, most of their stuff is with big global wholesale managers that want a minimum of $1 million or something. So it's kind of hard, but you can have a go at it. You can try.
Yes, I think you can. I guess the point is that perhaps maybe you have to, people at home may think about how much they have in Australian shares, and whether or not they should be putting some of that money somewhere else. Now, we're not telling you to do that by any means. It's just sometimes a good way to come up with some investment ideas or inspiration is to look at how other people do it. And I think the Future Fund is a great example, which is why we're talking about them today. And it brings us in to the next point, which I think is that there's more to a portfolio than shares. And I'll also say cash on that point, noting what you said about asset allocation earlier. Now, the Future Fund lists a third of their portfolio in unlisted assets. So can you talk us through why they're unlisted and give us an example or two along the way?
Well, it has to do with what I was saying about the price or the cost of
mm-hmm.
liquidity. Unlisted assets tend to make a higher return than listed ones.
Mm-hmm.
That's true. I mean, obviously there are times when the stock market goes up a lot,
mm-hmm.
and the stock market then outperforms unlisted assets. But the thing is that volatility is the enemy of good returns over the long term, and so if a value of an asset's going up and down a lot, it's really unsettling.
Absolutely.
And also produces lower long-term returns. So, and unlisted assets tend to be revalued, periodically.
Mm-hmm.
That's how they kind of get their value, their returns,
mm-hmm.
is the kind of periodic valuation of whatever it might be. And that's a different process, obviously, to the marketplace valuation, as it were, which is kind of a herd mentality. It's a psychological valuation in many ways, whereas somebody, if you own an airport or a road or a piece of property, someone comes in and says, this is what it's worth. Here's the amount it's earning. This is the kind of future earnings stream of this. Discount it back to the present day, and that's the valuation. Well, that's a pretty sober process. It's not the kind of crazy ups and downs of markets, and that's part of the problem. I mean, sort of the best way to invest in overseas markets, because as we've pointed out, the future fund's asset allocation to equities in general, listed equities, is 33%, right?
Yes.
Which is much closer to the SMSF allocation to listed equities. However, only a small proportion of that is in domestic. If someone wanted to match the future fund, they'd put a whole lot more money into international shares.
Mm-hmm.
So how do you do that, right? Well, you can follow Clay Carter's model portfolio in Eureka Report, buy the stocks that he's recommending. That's had a patchy performance, but it's a way of doing it. You could pick your own stocks, or you can choose an international fund manager, of which there are a few. And obviously the easiest thing to do is to invest either in listed ETFs or in listed international fund managers like Platinum or Magellan or Alliston Global, which is what I've got my money in, or some of my money, which is the Ashok Jacob International Fund, which is going okay. But the trouble with all these kind of listed investment companies that invest overseas is that they're also subject to the vagaries of the market, even though the underlying assets might not move that much or might move in a different way. You know, the market is the market, you know. But really, that's kind of the easiest and best way to do it in a way. Alternatively, you have to go through an advisor, get your money onto a platform and put it onto a wholesale fund of some sort, which in brightday you've got some picked, haven't you? You've got featured funds.
We do. We have the featured funds on brightday. Now you can find them by heading to the research tab on brightday's website and filtering by managed funds and international shares. Now, if you're unsure of how to do that or what the outcome actually means, you can actually request a phone call from one of our brightday member services team, and they will happily walk you through how to use that particular tool. Now, I just want to quickly talk about infrastructure and property. Now, I know we glossed over them, but I think it would be really good if we could just go over the main points of what infrastructure actually is and what a property investment actually is.
Okay, one at a time. Infrastructure, well, it's roads, ports, airports, pipelines. So
stuff that we would use regardless of how much money we had in the bank or economic conditions, because we need it. It's vital to everyday living.
Now, Transurban is an infrastructure investment. However, it's also listed.
Yes.
So therefore, it's a listed infrastructure investment. So should you, if you invested in Transurban, should you include that as in your infrastructure allocation or your listed equities allocation? Good question.
I'm not asking you that one, but you may as well answer it now that you've asked.
No, well, I think it's listed equities. I mean, there's listed and unlisted. I think you've got to think about how much you've got in listed, how much you've got in unlisted, and to the extent possible, have a reasonable allocation to unlisted investments. But it is difficult to find those, and particularly if you're not using an advisor. I mean, you know, where do you go? I've had a couple of times in the studio, I've had people from a thing called Infrastructure Investment Partners, Infrastructure Partners Investment Fund, IPIF, Infrastructure Partners Investment Fund, which is a retail entry into the Hastings Fund called Utilities Trust Australia, which has most of its money in airports, plus some ports, plus it's a true infrastructure investment, and its long-term return is 11.6% roughly. So, you know, that's a way of getting an unlisted entry into an infrastructure fund, which is why I brought them in to, you know, show people there is that possibility. Blue Sky Alternative Investments also has infrastructure.
Yes.
I'm not sure whether you'd call water infrastructure. I suppose you would, actually. It's certainly an alternative. They'd probably, in the future fund, would probably put it under alternatives as opposed to infrastructure. And that's, they have both unlisted funds and their listed investment company. BAF is the code. Again, because it's listed, it would go up and down with the market, so you probably have to count that as a listed investment. However, the assets are definitely unlisted.
Right.
And what was the other thing I was going to say is the future fund includes timberland in infrastructure.
That's
so
right.
The allocation is to infrastructure and timberland. That's an interesting thing, why they've kind of specifically said timberland. But how to invest in timberland? Well, all those MIS, or those managed investment schemes, such as Timber Corp and Southern.
I can't help you out because I don't know.
Anyway, they all went broke, so they were terrible. Everyone lost all their money. But there are some still around. There's TFS Corporation,
Yes.
code TFC, which is a sandalwood business, but they also sell entry into investing in the trees directly, mostly institutional investors. So, I mean, there are possible ways to invest in timberland if you want to, but probably that is quite difficult as well.
And property.
Property, yeah. Well, I mean, the obvious way to do that is through REITs, real estate investment trusts, A-REITs and REITs. A-REITs being Australian real estate investment trusts. They're all commercial property. I've had Warren Ebert, who runs a business called Sentinel Property Group here. That's an unlisted commercial property investment for self-managed super funds primarily. And he's producing terrific returns for income returns, which he pays monthly, of between 9 and 15%. So, I mean, that's another way to go. There are a number. He's just one, but there are a number of unlisted property vehicles investing in commercial property. There aren't that many residential vehicles. In fact, there's only one I know of called Domicom, which I'm an investor in. Domicom is a fractional property investor. You can, via their website, Domicom, you can invest in percentages of residential property. Giving a big plug to my investment here. Apart from that, you buy a house or a flat.
Well, I'm going to cut you off on the property point there because we've got a bunch of audience questions.
Let's do it.
And we've got to get through them. But firstly, before we do that, just cover off on the last point that we talked about in our webcast invitation, which was how would you adjust your portfolio. There are just a couple of key points. You want to make any changes gradually because you want to avoid market timing risk, which is leaving one market, entering another one at unfavourable times. You want to make sure you keep a long-term view. Alan touched on it at the start. 10 years, remember, superannuation is a long-term investment. In fact, it's likely to be the longest one you'll ever have. You should do your homework on infrastructure and property investments. Now, completely unlisted investments are sometimes quite out of reach for retail investors, which Alan and myself are, and you at home are as well. So you've got to opt for perhaps a managed fund that might suit you best, but you need to make sure you do a little bit of research into what they invest in and their rules and their policies. So now we'll get stuck into the questions.
Let's go.
Now, the Future Fund has unlisted assets, but I have no idea how to research or get into these kinds of asset classes. What are your thoughts? So I think that comes back to we can't necessarily get the same unlisted exposure that they can do, so find the best managed fund alternative. Do you have anything else to add on that?
No. They've got 6.4% in property. Well, you can put your money into real estate investment trusts, unlisted property vehicles. You can put your money into a flat for some property, infrastructure and timberland. I mean, look, maybe what you should do is invest in Transurban and Sydney Airport, for example, which are listed equities, and call them infrastructure. They are infrastructure. They just happen to be listed. But if you're looking at the long term, the ups and downs on the market don't really matter. I mean, Transurban and Sydney Airport will behave over the long term as infrastructure investments. So that's one way to look at it. And Transurban, for example, is a wonderful business. Sydney Airport, well, goodness gracious, it's fantastic. So in the other alternative assets that they've got the Future Fund's got 13% in. Well, it is difficult. There are hedge funds you can get, which is included into alternatives. And the other one is Blue Sky, which we've had Mark Sowerby in. You really ought to look at Blue Sky as a possible vehicle for your alternative allocation.
So I've got a question here from John. Speaking of liquidity and return, I need to get 5% from my investments. Will I get that from property and infrastructure?
5%.
5% income
5% income.
from my investments, yes.
Oh, well, you won't get that from a term deposit at the moment. You might in a few years, but at the moment, to get 5%, you need to, you invest in BHP. They give you 5%.
But property and infrastructure as a whole, as asset classes, are they going to be able to provide an income or a yield of 5%?
Well, property definitely, commercial property definitely will.
Yes.
Depending how much money you've got, you might just buy a property, sit back and let it give you 5%. I mean, the problem with that is you've got to make sure it's rented all the time. If you went with an unlisted commercial property vehicle like Sentinel or something, they would definitely provide you with 5%. And because they have a diversified portfolio of properties, it's relatively secure. So yes, infrastructure, well, IFIP, which I've had a couple of times in here, definitely provides 5% income. I think that when you're investing in unlisted assets and infrastructure and property and so on, you should be looking at 5% income plus 5% capital growth,
Right.
for a 10% total return.
Okay.
That should be what's in your head.
Right.
That's what you get.
And you can actually find out what a fund has done historically to give you an idea of whether or not they're going to have any shot of delivering that to you in the future. All of that material, all that information should be available in any fund's marketing material or if you request it from them. We've got a question here from Joseph. Does the Future Fund have an allocation to Australian corporate bonds?
They have an allocation to debt securities of 12.7%. So that definitely includes corporate bonds.
Right.
Australian corporate bonds. I don't know how much of it is Australian corporate bonds. They don't disclose that, but it's debt securities in general. 12.7%.
Great. Craig has said, I got burnt on property in the GFC, not going back there, so what do you suggest? I've got some thoughts, but
Go ahead.
I was going to say, if you don't like the asset class and you feel uncomfortable and you're not going back, then you should avoid it. Where to go? If you're going by the Future Fund, I think they've got 6% in property. I'll just divvy that amount up across the other asset classes you might like. It's not 30%, so it's a different thing. Do you have anything else to add?
I don't have anything to add to that.
Okay. I think we've touched on it, but it seems like we've got a few questions along this vein, so we should go over it again. Mark wants to know what's the best way to buy unlisted assets. And I think that was what we were talking about before, that you've got to go through a managed fund that invests in those unlisted assets, but you have to do your homework to find them.
Well, I mean, the fundamental job of a financial advisor, which you know better than I do because you've been one, Kirsty,
yes,
is to act as a kind of a broker for managed funds. That's the job, I mean, a decent financial advisor should have a whole kind of cupboard full of managed funds and investments to show you. I mean, that's one way to do it. Another way is to get onto Google.
Yep.
Google your head off, and go to their websites, download the PDS, the disclosure statements, and do it that way.
Exactly right. I think that's good advice, and that's one of the reasons why we built the brightday featured funds tool, because we've tried to shortlist, we have shortlisted the managed funds that are available through the platform based on performance, and there are a couple of other filters that we've added into that, so that you can look at each of those funds and then go off and do your homework on them. So you've got a shortlist to start working with, because there are thousands of funds out there, and some are definitely better than others. So we wanted to give you, I guess, a starting point, because you could get lost in the Googling of funds.
You can, totally.
And you can uncover some great ones that you can't actually invest in. We've only got time for, I think, two more questions, but we'll ask them.
Get the best ones.
I'm trying to, but the screen keeps moving. All right.
It's a really bad screen, that.
I'm so glad you agree with me.
It's a shocker.
It is. Okay, Faye has got a great question. Would I be better buying a managed fund or exchange traded fund for my property investments?
Personally, I think you're much better off with a good managed fund than an ETF, exchange traded fund. Exchange traded fund will give you the market, what the market's doing. If you can't find a decent, or you're unsure about whether the managed funds you're looking at are any good, well, buy the ETF, because that'll just give you what the market does. At least it's safe and it's diversified. You're getting a decent amount of diversification, but you'd be better off always to find a good fund manager.
I'll agree with that. And a final question is, if buying overseas, should it be hedged to try and offset currency changes?
Look, I don't think so. I think currencies go up and down. We're talking the long term. I mean, if you have a short-term horizon, that is to say you need the money in 6 months, you're investing in, but you need the money in 6 months, well, yes, you definitely should hedge, because currencies are really difficult to predict. Absolutely. Over the short term. Long term, they'll go up and down. I don't think you should worry about that too much. I mean, if you wanted to hedge, the best way to do it is to invest via Australian dollars in a locally listed international investment vehicle, such as some sort of international ETF, or a fund manager like Platinum or Magellan, or one of those.
That's great. That's a great tip. I won't say advice. So that brings us to the close of our webcast. So Alan, thank you so much for joining me today and sharing what you know about the Future Fund and your thoughts on investing. I've most certainly found it insightful, and I hope our viewers at home have as well. Now, if you've got any questions, or you want to know how you can use Brightday's featured funds, or anything in general about superannuation, please feel free to register for a phone call from our member services team. We love talking about super, so we're happy to talk to you about anything related to super, or any questions you might have about investing. But otherwise, on that note, we'll leave you here. Thank you.